This is Trading Lesson 32, delivered by Twigbe Ezoge for forex traders, crypto, stock and option traders, and other chart-related traders. You're advised to subscribe, share, likes, and make comments. You can contact us for account management, training, and consultation on +234 803 759 7085. If you put it on for a trade, exit as a trade and take the loss. Otherwise, you will invariably hold it far too long and the loss will become many times larger than your original worst case loss. On top of that, it will be a constant distraction and interfere with your ability to place and manage other trades. It is very difficult to make money as a trader, and if you are able to do it, you deserve a lot of respect, especially from other traders. It does not matter how you trade. All that matters is performance. Just because something looks easy does not mean that it actually is easy. Whenever a trader sees the market pull back 3 or 4 ticks after a signal, it is a sign that big traders believe that the market is not likely to go far. Because of this, the trader will consider only trading range trades or counter trend trades rather than trend trades. Since this means that the market is probably in a trading range, experienced traders will tend to scalp rather than swing and look to buy low, sell high. When traders are trading counter trends, they will sometimes trade a smaller position, like half size, because they are willing to add on if the market goes against them. If they do, they might get out once the market gets back to their first entry price. They will then have a break-even trade on the first entry and the scalper's profits on the second. If you see a setup that you feel is a very high probability trade, the trade will likely be a scalp instead of a large swing. This is because whenever there is such an obvious imbalance, the market will correct it quickly. So, a very high probability, relatively low risk situation cannot last more than a bar or two. If you bought what you perceived to be a reversal, consider allowing the market to put in a lower low and then add on at the second entry. Swing traders can take a position and keep adding the same size position with each subsequent signal after they have a reasonable profit. The stop on the entire position is the stop of the most recent addition, which usually means that they will have a profit on their earlier entries, even if they lose on their final entry. They would also exit before their trading stop was hit if the market generated a signal in the opposite direction. Just as a scalper sometimes swings, most swing traders end up with loss of scalps. Once swing traders believe that their premise is no longer valid, they exit often with a scalp. At the end of the day, beginners will look at the chart and see a strong trend and wonder how they missed it. The reason is that all big moves are uncertain as they are unfolding, and this traps traders out of the strongest trends. It also traps traders into counter-trend trades, resulting in repeated losses.